Time for Yahoo Finance's Market Minute. Stocks edging higher as investors weigh the possibility of thawing trade tensions between the U.S. and China. President Trump saying he had a, quote, very good call with President Xi Jinping that was focused on trade. Teams from the two countries are expected to meet shortly. Tesla shares are extending declines from Wednesday's session as CEO Elon Musk blasts the GOP budget bill. Musk calling for lawmakers to kill the bill, citing the potential effect on the U.S. deficit. Of course, the bill includes cuts to EV tax credits as well. Several reports suggesting Musk was unsuccessful in lobbying to save those tax credits. And Kering, owner of luxury brands like Gucci and Balenciaga, is reportedly in exclusive talks with a buyout group about the sale of its Fifth Avenue building in New York City. The retailer just bought the building over a year ago. That's according to Reuters. And that's your Yahoo Finance Market Minute this morning. For more on what's trending on Yahoo Finance, scan the QR code below.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Check-In. Why now is the time to look for entry points into beat-up companies. We'll discuss that. Plus, the pulse of small businesses. One insider shares advice for navigating tariff uncertainty. Plus, the cost of care is causing many Gen Z and millennial adults to question whether or not they want kids. We'll discuss that. A lot to get to during today's show. But first, we take a look at some of the market action 90 minutes into the trading day. Stocks right now, not even futures, just the major averages here, as I'm trying to change the lexicon from our morning brief coverage this morning. The Dow Jones, the S&P 500, and the NASDAQ all fractionally higher here right now after President Trump spoke to Chinese President Xi Jinping about trade between the two nations. My next guest says it's still a stock picker's market amid the volatility. Joining me now here, Matt Powers, Powers Advisory Group Managing Partner. And you say that investors should be looking for entry points into some beaten up companies. So which companies have the black eye right now, and who are you trying to ultimately make sure that those opportunities pay out for investors for?
Yeah, good morning, Brad. Thanks for having me. This headline theme continues in 2025. You literally just said it, but just the policy whiplash, the uncertainty, markets, they're still reacting to headlines, and every presidential threat's followed by a pullback, which is having less impact. And we learned that Trump he threatens, backs off, and it's less impactful every time. Yeah, chaotic policy process. It kind of makes it tough. It makes it tough on, where to go, what to look at. So what we typically do, we're looking for certain criteria on these companies, and there's a few defensive staples, utility, those types of companies have lagged, and obviously, tech, discretionaries, healthcare, that area has picked up. So, contrary to what you might think, we're actually looking at specific discretionary names.
And so with that in mind, those discretionary names that you're keeping tabs on that have also, for some of them, really had to navigate a consumer environment that's trying to figure out how they're either continuing to spend or where they're very fiercely pulling back. So what makes for a strong discretionary name that can perhaps prove dividends for investors longer term?
Yeah, so we're looking at companies that are specific within that discretionary sector, and they're really hitting our screen. So there's some opportunities with nice valuations, strong dividend growth, low payout ratios. Even if out of favor, it could shake out to be that type of situation where you turn around a year from now and wish you would have taken a look at these types of names. So, specifically, and again, these are out of favor. Lennar, the home building subsector is beaten down. U.S. housing market's deeply undersupplied. It's a gap that's going to take some years to close. But that supply-demand imbalance should support some strong pricing power, for home builders. And Lennar is the second largest home builder in the U.S., so they're well positioned. But it's really the numbers that we're seeing. So the yield is roughly 1.9%. We're always looking for dividend growth, and they've grown their dividend over the past 5 years over 60% on average per year, which is pretty staggering. Payout ratio 14%. And they're trading at 10 times forward, so they're attractive valuation. Williams-Sonoma is another one. So, everyone knows the namesake. That's like high-end coffee makers, cookware, appliances. I was just in a store the other day, but they also own Pottery Barn, West Elm, in same thing, yield, their dividend growth over the past 3, 5, 10-year period is double digits and very low payout ratio. Lastly, Tractor Supply Company. So, and again, these three are all discretionaries. So Tractor Supply, it's the second largest, or actually it's the largest consumer farm specialty retailer in the US, but they've got that specialized product mix, things that people really kind of often need right away. They're expensive to ship, and it kind of helps insulate them and limit some of the competition from online retailers. Yield similar to Lennar, 1.9%, but they've grown 3, 5, 10-year periods on their dividend over 20%. So, and again, attractive payout ratio, PE is forward PE looks good. So all three of these are names you could enter into as long-term holdings, if you, especially as a dividend growth investor.
And so with that in mind, are there names that investors would be right to take profits from right now in order to put those gains to work in some of those names that you just mentioned?
Yeah, possibly. I mean, since our April lows, you've got tech up 30%, you've got industrials up 23%, you've got discretionaries over 20%. And I just mentioned those, but defensive stocks have lagged. We know that, and they're actually maybe attractively valued. But if I'm looking anywhere, it's kind of difficult because trading right now, there's noise everywhere. So you have to think longer term areas as we work through it. So you think AI, that's not going away anytime soon in the tech sector. Cybersecurity, you could almost look at that as a staple within the tech sector. Everyone needs to have cybersecurity, period. So it just kind of pushes you into looking at these beaten up names. But if you're going to push away, you could start to trim some positions in the tech. A lot of our clients, and I hate to name specific names of companies, but you look at Microsoft, and that's a heavy weighting on our portfolio. So Microsoft's one of the few names I'd be okay with having some concentration risk in. But there are names like that you can start to trim and add some things that have been beaten up.
And just lastly, while we have you here, what type of weighting are you placing around the Fed, if any, at this juncture? We know that there's about 50 basis points of cuts that the markets are trying to price in to the end of the year. But what is the reality of how that would play through in portfolio strategy from your own analysis right now?
Yeah, I mean, it's the important area. It's what everybody's looking at. But they paused the last three. Unemployment has stayed low. I mean, we're going to find out pretty quickly where we're at there. But we need to understand how tariffs will price through, and that may not be till closer towards the end of the year, Q3, Q4. So we don't see an urgency in cutting. If inflation cools and growth slows, even if jobless numbers stay low, they may consider some cuts to support. So we'll see where they stand. And lastly, this is interesting. This wealth effect. Just want to mention it, and there's zero way to quantify this. But the market goes up. We just saw this run up in May. People feel good, and then they spend, which kind of leads into that whole discretionary idea.
Matt, good to see you as always. Thanks so much for taking the time.
You too. Thanks, Brad.
Now time for some of today's trending tickers. We're watching Brown-Forman and DJT. Joining me now, we've got Yahoo Finance senior reporter Ali Canal. First up here, let's set the stage with the more liquefied of both of these two companies. First up, Brown-Forman sliding after reporting weak fourth quarter results. Net sales falling more than 7% from the prior year and coming in below estimates. The alcohol beverage company also expects organic net sales to decline for fiscal year 2026 here. Shares also in decline right now by about 17%, Alex.
Yeah, Brown-Forman, the parent company of Jack Daniels, Woodford Reserve. Clearly investors not liking this report. Fiscal Q4 earnings coming in at 31 cents a share, missing estimates by 3 cents. Sales fell 7% to $894 million, also well below forecast. And we also had profit drop to $146 million, down from $266 million 1 year prior. So the actual results not looking too good. And then in the year ahead, as you mentioned, Brad, organic sales, operating income expected to decline in the low single digits. In the background, we have consumer uncertainty, potential new tariffs, weaker sales of non-branded used barrels. Add that all up, and the CEO of the company saying the team expects continued headwinds into fiscal 2026. So it looks like investors taking into account all of these potential risks at the present moment and also for the future.
Yeah, we were talking about this one in the newsroom. I called this one in our Slack channel, the Sydney Trade, our own beloved voice of the people, Sydney Freed. You can catch her on Stocks in Translation. But this actually might be the the Prosubramanian trade, given that he's visited one of the Woodford distilleries. Also, keeping things trucking along here, Trump Media taking its next step towards launching an ETF, filing an S-1 document with the Securities and Exchange Commission, known in your hood as the SEC, to introduce a Truth Social Bitcoin ETF. What do we know about this one?
Yeah, so this is the second key filing to the SEC, which has until January to make a final decision. Now, this ETF would join a growing list of spot Bitcoin ETFs from big names like BlackRock, Fidelity, Grayscale. For context here, BlackRock's Bitcoin ETF has already racked up nearly $70 billion in assets. It's one of the biggest ETF launches ever in the US. And all this comes as Trump Media is really making a bigger bet on Bitcoin, saying it plans to build one of the largest Bitcoin treasuries of any public company. The move is backed by a $2.5 billion private funding round with about 50 institutional investors on board. And once the deal closes, Bitcoin's going to sit right on the company's balance sheet, along with about $760 million in cash and investments here. But if you take a look at Trump Media shares, they're off about 1.5%. You're looking at a yearly chart. You see that huge spike that we saw around the election in November, and we've just been on a steady decline since then. Year to date, we are down about 37%. We're right in the midpoint of the 52-week range. A lot of folks thought heading into the election, the results, that Trump Media could maybe be an asset here. And we do know that Truth Social has been the main form of communication from the president. But that hasn't necessarily translated to the pricing action that we've seen. So we'll see if some of these Bitcoin moves can lift DJT shares. It's a tongue twister, say that 3 times fast, in the future.
We'll continue to watch these, and you can scan the QR code below to track the best and worst performing stocks on the Yahoo Finance platform with Yahoo Finance's trending tickers page. Allie, thank you.
Awesome.
Coming up, our very own Jared Blickery breaks down market caps and why they matter. Plus, advice for small business owners navigating the uncertainty in the landscape right now. All that and much more on the other side of this short break. You're watching Wealth.
Companies, much like boxers, compete in different weight classes. Market capitalization tells you how big or small they are, but is bigger always better? I'm Jared Blickery, host of Stocks in Translation. Now, market cap, for short, is simply the current share price multiplied by the number of shares outstanding, or shares out, as they say. Investors started using market cap in the early 20th century as a quick shorthand, sizing up companies instantly, just like boxers before a match. Take NVIDIA, recently reclaiming a heavyweight title with its $3+ trillion valuation, which reflects huge investor confidence in its AI domination. Now, these weight classes help investors quickly gauge risk and reward. Large cap stocks, they tend to be more stable, meaning lower volatility. But smaller fighters, small and mid cap stocks, they can punch above their weight, delivering bigger swings and potentially higher returns. Market cap alone, though, it doesn't show the full picture, especially if you're considering buying a company. For that, many investors, and this includes Warren Buffett, they use enterprise value among some other measures. The formula for enterprise value, or EV, is very simple too. It's a company's market cap plus its debt minus the cash it has. And that might seem a little bit counterintuitive at first, but here is the logic. If you're buying a business, debt is something extra that you're going to have to pay off, raising your costs. But if there's already cash on the balance sheet, that's immediate value for you. So that's why we add debt and why we subtract cash. Now, finally, here's another one that you might have heard of. The price to earnings ratio. The PE ratio lets investors quickly see how expensive or cheap a stock is relative to its earnings. It's just the stock price divided by earnings per share, or EPS. A high PE suggests high expectations, like betting big on a young boxer's potential who's recently been delivering knockouts, while a lower PE might signal a seasoned fighter that's undervalued or past their prime. There are many other measures of value, so this is not exhaustive by any stretch. But think of market cap as the weight class, a quick glance at size. But to pick your champion, you're going to look at enterprise value and profitability metrics, the stats behind the boxer. At the end of the day, sometimes size matters, but it's the deeper data that'll win you the match. And tune in to Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, next boxing match. I guess we're watching it together.
You bet.
All right. Switching gears here. Many businesses are passing off tariff costs to consumers, according to fresh data from the New York Fed. Nearly a third of manufacturers and 45% of service firms fully passed along all tariff-induced cost increases by raising prices. Joining me now on set to help us understand the pulse of small businesses, we've got Mark Valentino, who is the Citizens President and Head of Business Banking. Great to have you back here in studio with us.
Thanks, Brad. Great to be here.
So let's talk about this. What is the pulse right now of small businesses and how they're really weathering through what they can pass on to consumers versus what they can incur themselves?
So I think they're trying really hard to limit the amount that they pass on to consumers, but it's obviously, there's a cap to that because the costs are coming in so fast and furious. They obviously want to stay close to their customers right now, and at some point, if they raise prices too high, their customers aren't able to afford their products or services anymore. And then they run into larger companies that might be able to keep costs fixed to get more market share right now. So it's a very big concern for small business owners. I've actually, in meeting with some of our customers, I found some really creative solutions. Some of our customers are actually negotiating directly with their vendors overseas to say, hey, this isn't good for your business either.
Really?
Because you are going to see a slowdown in your US sales, and so help us by helping you. And so they're actually negotiating like a 50-50 split in the tariff price increase so that it gets absorbed a little bit on both sides and ultimately doesn't slow down necessarily purchasing happening over here in the US. So big concern though.
That's interesting, and it highlights the fact that it's easier for them to go back and negotiate with existing partners than it is to try and drum up entirely new partnerships and look at their supply chain and figure out how differently they would need to source if they did kind of uplift or uproot some of those existing relationships right now.
Yeah, we're seeing them do both. You absolutely have to keep your options open right now as a small business in the US who purchases goods from overseas. So whether you look for domestic options to purchase goods or you find new partners overseas, you have to kind of explore all options. But your best option is always to try to negotiate with your current partners because they're going through the same pain that you're going through.
We were speaking yesterday with ADP's chief economist, Naylor Richardson, who was highlighting within the most recent private payrolls print, which came in well below expectations, the pressure that small businesses are seeing on the labor side. What are you hearing? I
am glad you brought that topic up, Brad, because all we talk about right now is tariffs. The number one pain point for US small business owners is actually labor. It's actually the labor market, and it's actually how wage pressure has gone up even through COVID and all the way to now. And so we're not talking enough about the stress on the labor market, whether it's due to immigration policy or just a constrained labor force in the US in general. We absolutely have to find ways to create more people entering the job markets right now, and it's especially critical for small business owners who perhaps don't have as much technology to fill those gaps as larger companies might have.
And within that, it's the price paid, the wages that they're talking with potential employees about. It's also, and you touched on this a little bit, within the immigration and the broader crackdown that we're seeing as well, you've got employees that are afraid to show up to certain workplaces as well right now.
Absolutely, that's all happening, it's all true. I think as an administration, as a country, we need to figure out how to create legalized immigration to create more jobs in this country. I think it's something that this country has always been built upon, was having a healthy immigration market to come and fulfill jobs in this country. And so I think it's something that we as a country and as a society absolutely need to solve for, because to your point, there's a lot of fear out there right now. If you are an immigrant in this country, legal or illegal, if you show up for work, something bad might happen, and it's certainly having an effect on business ownership and business operations.
Something else that's under the radar right now, and I'm glad that we get to talk about this, is the number of small business owners out there that just don't have a succession plan.
Yeah.
And a lot of small businesses, we know, especially if it's a mom and pop shop, you rely on that next generation to really take the torch and say, okay, I know how to run the business. I know that this is something that our predecessors have put together to build generational wealth. What are those conversations like right now?
So, based on one of our partners that does a lot of broad-based customer surveys, 42% of small business owners are going to need succession in the next 5 years based on the aging out of business ownership with baby boomers. So an amazing statistic. 4 in every 10 businesses are going to pass hands in the next 5 years. We've been really investing in wealth management at Citizens. And as part of our small business kind of proposition to customers, one of the things that we're doing is trying to get more of our customers in front of our planning process from a wealth standpoint. A lot of small business owners think, oh, I'm not wealthy, maybe my business is worth something, but I don't have a lot of cash, this is not for me. It's the planning process that's important from a business ownership standpoint. Are you doing things tax efficiently? Do you have a plan in place? Who are you going to hand your business over to, and how? Because the how is actually quite an extensive process of passing on the torch. It's not just like, here's the keys to the company, see you later. Yeah. And so there's a lot of planning, and it's actually 3 to 5 years of planning in most cases that needs to go in. Do you have an employee today that you think could take on the torch if you want to pass it on? Is it a family member? Or do you need to sell the company? And if you do need to sell the company, you are going to get a much better valuation if you plan for that a couple years in advance than waiting to the moment in which you need to sell. Or I would even say worst case, because we see this happen as well with customers, a health event occurs to the primary business operator, and what that business could have done from a succession plan is no longer feasible, and there was no plan in place.
That's a really good point. Mark, always a pleasure to speak with you.
Thanks, Brad.
One of the best ballparks, I will say, in the MLB as well, Citizens Bank Park.
Thank you very much. Glad to be here.
Likewise. The number of first-time home buyers surged during the pandemic, with 2.4 million first-time mortgages issued in 2020. And while buyers faced low home supply and rising prices, they were able to lock in lower rates before the Fed hiked interest rates to combat inflation. But now, as some of those buyers prepare to sell their homes, they're struggling to break even. Yahoo Finance senior housing reporter Claire Boston is here to break it down for us. Claire, what do we know around this?
Hi, Brad. So we are looking at an environment where a lot of people who maybe bought their homes 5 years ago in those crazy pandemic times are now looking to sell. You know, the home no longer fits their needs. Maybe they've had a life change, but they are selling into a market that looks a lot different in most parts of the country. And as a result, it may be hard for some of those sellers to break even on their purchases. Traditionally, it takes at least 5 years, but sometimes more like 10 years to break even on that home purchase. And right now in this market, prices are not appreciating as fast, and they are, even falling in some markets. And all of that is a really tough environment for those, especially first-time sellers, to be.
And we do know a new report as well from Apollo shows the share of first-time home buyers had actually shrunk from 50% in 2010 to 24% in 2024. What is behind this drop, and what does it mean for the housing market?
Yeah, I mean, it is an absolutely crazy number. And what we are really seeing there is just a story about how hard it is to afford a home now. Mortgage rates are high. All-in prices and what you need to bring to the table in terms of a down payment are quite a bit higher. And that is causing issues for those home buyers to enter the market for the first time, especially when you think about the fact that those first-time home buyers may be competing with return buyers who are buying in cash. So it's really tough out there.
Claire, thanks so much for taking the time.
Thank you.
Coming up, we get the inside scoop on air travel demand with the CEO of Breeze Airways. That is next on Wealth. Oh yeah, there you see him. Let's get a check on the markets as we are 2 hours into today's trading session. I'm taking a look first at the Dow Jones Industrial Average. It's up by about 0.3% right now. We did dip into negative territory. We were there for much of the 10 a.m. hour. Then you got a Truth Social post from President Trump saying that talks with China and Chinese President Xi Jinping went on, and the confirmation of that and perhaps some of the tenor of that conversation boosting markets here. As of right now, we're seeing fractional gains for the Dow. The NASDAQ Composite, also fractional gains, up by about 0.7%. And the S&P 500, that's up by about 0.4% right now. I want to take a look at some heat map activity, just so you can get another sense of how things are transpiring during today's session. Take a look at the NASDAQ 100. We'll start things there. We are seeing a little bit of a pullback here on Tesla on the day. That's down by about 3.3%. Let's put that on a year-to-date view here. Still down bad right now by about 20.5% over the course of 2025 here. You've got some of the other Mag 7 tech stocks holding on to gains right now. NVIDIA, Amazon, Microsoft, Apple, Google, Meta, Google, of course, also Alphabet, whatever you want to call them up. The Dow Jones Industrial Average, you're also seeing those 30 components largely in the green here. The deepest of the decliners as of right now, Procter & Gamble. Procter & Gamble did announce that restructuring plan and some cuts that are going to come forward that ultimately impact, I believe it was 15% of their non-manufacturing workforce here. And so ultimately that is one of the things knocking around, as that company has also announced some of its own ambitions to lean into certain segment categories within the business. Shares here year to date down by about 2.3%, here today down 1.3%. Amazon, the leader for the Dow Jones Industrials. All right, that's up by about 2.4%. As policy uncertainty rattles consumer confidence, more Americans are choosing to road trip rather than to fly in order to save a little money. For Memorial Day, the number of people who decided to drive rose to the highest level in 20 years, 39.4 million, according to AAA. We want to get the inside scoop on flying demand with David Neeleman, who is the founder and CEO of Breeze Airways. Great to have you here with us. What are you seeing in travel demand right now for people who still want to take to the skies for summer, and what the bookings look like for Breeze?
They look good. We're pleasantly surprised. We've had record booking days this month. You know, we try and fly in markets where you can't drive. If it's more than if it's less than a 6-hour drive, we usually don't fly those flights. We like to be 6+ hours, and we also like to be the only nonstop in the market. So what we find is that we just generate more traffic if we can get you there twice as fast for half the price. People maybe get a second home in Vero Beach, which we're the only airline that flies there. Or if you're in Huntsville, Alabama, and you want to go to Vegas, you don't have to connect over, you know, one of the hubs. Or if you want to hop down to Orlando, maybe you go 4 times a year instead of just once. So, you know, that convenience and the value proposition creates just a lot of demand. You know, we're in 72 different cities, and we have over almost 300 routes, 200 flights a day. So we're getting big, 31 states, and people are loving what they're seeing with Breeze.
And on the pricing mechanisms, how have you been able to make sure that you're still at a price point that, even with those nonstop flights that are highly attractive to a lot of flyers out there, that you're still maintaining your own margin basis that your business has come to expect?
You know, we have a really premium product, and people love it. Our NPS scores are off the charts, the highest I've ever been seen in an airline that I found, and this is my 5th. What we do is we say, look, $49, you want to go for that? You want to bring a backpack on? That's great. But if you want to pay us another $50, we'll throw in a carry-on, a check bag. We'll give you free Wi-Fi. We'll get you a couple extra inches of legroom. And then if you want to go first class, you know, you can do that as well. And our first class cabin usually sells out quicker than anything else. So it's a premium product, and it's easy to understand. People don't feel like they're getting nickel and dimed. They know what the proposition is from the beginning. If you're on a real tight budget, that's great. Or if you want to splurge a little bit, that's great. We'll take care of everybody.
And it's so interesting because when you talk about some of the add-ons, that's typically where the mindset previously would go for a lot of consumers, in feeling like they were getting nickel and dimed and having to pay for just being able to take a bag with them or to be able to check a bag. So how are you seeing the mindset among travelers in terms of what they want to spend more into versus where they're saying, okay, this is where my cutoff point is? How are you seeing that mindset change now, as many of the airline operators, especially the big 3, big 4, are starting to charge more for premium?
Yeah, you know, I think it's just different strokes for different folks. And what we find that's interesting is that maybe on some of the ULCCs where people just feel like they got fleeced. You know, you may get a ticket for $70, but you check your bag is 75, and the second bag's 75, and next thing you know, you bought a fare for 70, but you're paying 150 just for your bags. That makes people mad, and they don't want to come back and fly those carriers again. So we're really upfront from the very beginning. You know, do you want, you know, in Southwest case, they start charging for bags, and people are mad about that. But we just say, here's our fare if you want everything included. Here's our fare if you want to, you know, go on a budget. So it just depends. It's, you know, people. What we find, and this is really interesting, when people fly us the second and third time, they actually spend more. They up their bundles because they walk by that first class seat and say, wow, I could have got first class for another $100. I'm going to do that next time. Or I'm going to get in this extra legroom seat and get free Wi-Fi. So instead of figuring out how to game the system, they actually buy up. because they think it's really a fair proposition.
I got to hustle to my finish here. I got two more questions, though, that I want to squeeze in. One, which is, and you mentioned Southwest Airlines. We've had the opportunity to speak with Bob Jordan. I've also spoken with Delta CEO Ed Bastian earlier in the earnings season. And I asked them both this question about new plane builds and taking delivery of aircraft. What does that look like for Breeze as well, knowing that the tariff impact is one that has made every major airline operator think about taking delivery of planes if they had a tariff that was also on top of them?
Right. So thank goodness we have all brand new Airbus A220s. They're assembled in Mobile, Alabama. There is a tariff associated with that, but it's we don't have that provision in our contract. So we have one airplane we're taking today. We have 3 more being delivered by the end of the month. No tariff, no problem with us. But I think this is going to work itself out because the U.S. is a net 6 times exporter than we are an importer. It's crazy. If we tariff aviation, the U.S. is going to lose big time because we export $126 billion worth of stuff last year, and we only imported $20 billion. So there's a lot of really smart people talking to the Trump administration saying, let's exempt aviation. Otherwise, the United States is going to get slaughtered on this proposition. It won't be good for us at all.
And so that in mind, what happens then if we, on the other side of this, and it's not a tariff, but it is an impact to aviation, if we do see people who come into the U.S. from international places of origin and also want to be able to kind of hop city to city when they do get to U.S. soil as well, as we know that some of those trips are daisy-chained. You make your way to North America, you want to be able to hit a few cities in that swoop. And so all that considered, we've seen this most recent travel ban get implemented. What is the thinking, what is the pulse around some of the executives in the industry like yourselves when you see headlines like that and moves like that roll out?
You know, I think it's a bit of a challenge for the airlines that have international networks that are bringing international people in. Of course, virtually all of our business is domestic, but I think there's kind of a tick-off factor. I think there's people in the U.S. outside the U.S. that are saying, I'm not going to go to the U.S. this year. I'm going to stay in our country or fly to Asia or do something differently, and that's a concern. We're seeing Canadians not come to the U.S. in record numbers. They're basically saying, I'm going to pass on the U.S. this year. So, hopefully this thing all gets resolved because it is having an impact on those carriers that are bringing international travel into the United States.
Do you think there's an overarching kind of knock on the total addressable market here in even the U.S. travel or travel more broadly, if that is something that continues to have to be a headwind?
Well, I think for us, it's consumer confidence. If people feel like they're going to lose their job, travel's down on the pecking order after your rent and your food and all that stuff, and then you have travel. So if people feel like they're going to keep their job, if they feel good about the economy, then they're going to travel. If they're a little bit scared, and they'll pull back, and that's obviously the biggest concern. But there's a balancing with us because we don't have nonstop competition on 87% of our routes, and when you see that slowdown, fuel usually goes down. And if we can save on fuel, that kind of offsets some of the revenue softness. But we're not seeing that right now. We're booking away and doing great.
All right, David, I'm on the flybreezewebsite.com right now, so I'll let you know how my next trip goes.
Thank you.
All right.
Look forward to seeing you on board.
Thanks.
Bye-bye.
Coming up, we break down the impact of high costs for reliable childcare on Gen Z and millennials. That's next on Wealth. A new survey from Care.com shows Gen Z and millennials are questioning having kids, with affordability and reliability as main concerns there, and especially when it comes to child care. Only 30% of adults aged 18 to 44 said they definitely want kids, while 44% say they have no desire. 68% of respondents note that the cost of raising children makes them less likely to become parents. Here to dig in is Brad Wilson, CEO of Care.com. You've had a busy day. We've seen you at opening bell ceremonies.
It's been a busy day.
My goodness.
Yes.
Thanks for joining us back at the studio here.
It's great to see you, Brad.
Let's just go into the data here. Why are we seeing this as the pushback, the major pushback as it comes to family formation as well, and the cost, and where we can start to remove some of that cost from the system?
Yeah, I think some of the story is not new, and then there's a part that is new, which is really the mental anguish. But we all know about the cost of care. 40% of household expenses today go to caregiving, 22% go to childcare alone. So enormously expensive, and as we've seen over the past decade, caregiving's had about a 260% increase in care, particularly childcare expenses versus, say, normal inflation over a decade of around 3% per year, call it less than 100%. So exorbitant costs. I think what we're seeing now as a result of that, and don't forget, this is an access story as well. So we saw through the pandemic and COVID, a lot of childcare, daycare centers shut down. Care.com and benefited mightily from that with our in-home caregiver pool. But the fact is, it's really hard to find affordable, quality childcare. So that is playing out in the mental toll we're seeing with parents and families. We've reported and see that 90% of parents are reporting losing sleep as a result of having to find and manage care. And even almost 30% have reported that they've considered self-harm. So it's a really taxing time.
Well, then you also have some of the elected officials that are saying, well, wait a minute, we got this bill that's going to work its way through. It's going to give you $1,000 if you have a kid. It's going to give you access to a MAGA account, as they were calling it. I mean, some of the efforts that we're seeing get put forward don't actually address, at least from first glance and observation, the more deeper entrenched issue that you were just laying out a moment ago.
That's right, yeah. I mean, listen, we want to applaud the administration. It is definitely on their radar. They're definitely starting to notice and address this. And I think we'll all be better as a society and as a nation when we view this as not just cost, but a true investment in infrastructure. And so that is the work that we're trying to do day in, day out with the administration. I will remind everybody too, the bill's not done yet. So yes, they've given a nod to the child care tax credit. It is nice. It's going up from $2,000 to $2,500 per child. But in fact, the child independent care tax credit, the CDC-TC, is the only mechanisms by which it goes directly towards child care. So that, unfortunately, still needs more work, and that's the work we're trying to do with this administration, and we look forward to working with them.
What type of regular communication are you able to have with either elected officials, the administration right now? What are they malleable on from what you can gauge at this juncture?
Yeah, well, they're quite busy, as you know. So we're really trying to get to some pre-COVID levels on the CDC, TC, as I mentioned. But we're also just trying to inform them that, hey, perhaps we can modernize some of the language. And in fact, some of these credits and refunds were thought of decades ago. So it is not caught up and modernized with inflation. So we think a good starting point is that child independent care tax credit. But perhaps in the future, we've put forth something called a working family savings plan that can act very much like a 401k or a 401k, if you will, that it could be pre-tax dollars put towards childcare. It can travel to and with you from employer to employer, and you don't lose it. So those are the types of ideas we're trying to put forth.
Not to ding you on what you just mentioned a moment ago, and I know that this is a common way that we kind of think about needing future generations in the future, because we say, well, infrastructurally, we need more workers, or infrastructurally, we need more people to be part of the engine that drives our economy, while we also get away from remembering that familyhood and being able to have that sense of belonging and care around us as well is critical. And this is where I think a lot of future generations really have a hang up, is that we may have lost the prioritization of that in favor of economy. How do, when we see surveys like the motherhood survey and the stress factors that are being placed on mother, how do we recenter around family values, knowing that economy is only going to be driven by those values as well?
Yeah, listen, it's a great point. I'm a family man, a father of three.
Yeah.
It's very important to me. I just know the tremendous joy I get out of being a father and having a family. And to your point, there's also broader community. And in that community, be it your neighborhood, your churches, we all know it's a village, and we all care for each other's children and look after them. So I do think we do need to get back to that. I think the reality is in our society, though, we are much more transient than ever before. So we lose a sense of that. The other dynamic here, too, is it is a bit surprising probably to learn that most families have 5 caregiving occasions in their home at any given time. So if you think about an aging loved one, your pet, and the stat that really should get people to peek up is by 2034, we'll actually have more seniors in this country than children.
Right.
That is an alarming stat. So back to your question, listen, it takes a village. We think we can play a part of that by providing a caregiver in the home. But in fact, we also encourage people to look at friends and families and neighbors within their community to help foster a sense of belonging, as you said.
Brad, always a great pleasure to catch up and good to hear some of the insights, especially where you're moving the dial in those conversations.
Yeah, Brad, great to see you.
Likewise.
Yeah, take care.
Coming up, everyone, how to know if you need to change your W-4 withholdings as our mid-year financial checkup continues. U.S. jobless claims came in higher than expected for the past week, with 247,000 initial claims, coming on the heels of a softer than expected ADP private payrolls report. Workers may be looking more closely at their income and salary. And to continue our week-long mid-year financial checkup, I want to bring in Justin Samples, who's the Ameriprise Financial Private Wealth Advisor. Justin, good to have you here with us. So how can you do a mid-year audit of your income?
I think the first step is getting a good understanding of your cash flow. That's honestly the bedrock for successful financial planning. And, to be honest, understanding your take-home pay is about more than just reading a paycheck. It's really knowing what's truly available after taxes, benefits, and deductions. And that really is useful for two purposes. First, it allows us to understand your current lifestyle for projecting out into the future. Second, it allows us to establish appropriate cash reserves and protection planning goals. So typically for clients that have more stable incomes that are less economically sensitive, we're looking at 3 to 6 months worth of reserves. Clients that have more variable incomes or in sectors of the economy that might be more economically sensitive, we typically recommend larger reserves, like 9 to 12 months, so that people can maximize their savings, invest for the long term, but also have confidence knowing that they have enough liquid reserves to offset maybe disruptions in income that we're starting to see play their way out throughout the economy.
How do you know if you need to adjust your W-4 or your withholdings?
That's a really good question. And it's interesting because tax planning is probably one of my favorite parts about what we do, because it's the biggest bill we all pay, right? And it's often a topic people like to avoid or just turn a blind eye to. And so people forget that tax withholding is not just a set it and forget it item. Changes in tax law that we're seeing work its way through Congress, changes in your income, bonuses, things like exercising stock options, or changes in your deductions like mortgage interest or child care credits can all throw off your estimates. So oftentimes I recommend clients working with the withholding calculator on the IRS website is a good free resource for clients to be able to adjust proactively throughout the course of the year. Also working with your local tax professional, just getting a second set of eyes on that, because ultimately your goal isn't a big bill that can be a big tax bill surprise or to get a big refund. The goal is accuracy and getting as close as possible.
That's a great point. What about your workplace benefits? How do you do a check-in on what you're actually using versus what you're not actually using?
Yeah, that's maximizing employer-sponsored benefits is often an overlooked part of people's comprehensive financial planning. And your employee benefits package is incredibly important. It's part of your total compensation. In some cases, taking advantage of what's available in there can be more valuable than a raise. So looking at things like maxing out your 401k, taking advantage of employee stock purchase plans, life and disability insurance, making sure that you're contributing to your FSA before year-end deadlines, and then also thinking about your PTO more strategically to avoid burnout. Ultimately, if you don't use those benefits, you're leaving money and quality of life on the table.
Is now a good time for workers to ask for a raise, and how do you have that conversation?
I can understand trepidation about asking for a raise given some of the unemployment numbers that we just saw, and given the uncertainty that we've been faced with the market and economic environment. But the short answer is yes. Self-advocacy is a key part of self-development in anybody's career. Like I tell my kids, if you don't get, if you don't ask. However, how you ask is critical. Positioning your ask as a win-win by demonstrating your understanding of the organization's performance, and then tying your individual contributions and accomplishments to the organization's achievements will increase the likelihood of getting what you want while avoiding the possibility of that conversation becoming adversarial. I typically just recommend being fact-based, documenting your accomplishments, quantify your value, and then more importantly, or perhaps as importantly, time your ask around performance reviews and budget planning cycles. a raise isn't just about cost of living. It's about being paid fairly for the value that you create.
Sounds like your kids might be very knowledgeable on how to ask for that new Nintendo Switch 2. Justin, thanks for taking the time.
Hey, thanks for the time.
You got it. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time.